Mexico weaponizes. Silver export licenses cut 45% of global supply. COMEX cornered. While industrial manufacturers scramble for physical metal, while solar panel production lines face shutdown scenarios, while Dubai dealers quote $127 per ounce, the paper market still shows $73. 45% of global supply, gone. Not reduced, not delayed, gone. The licensing system went live January 14th. By January 18th, 3 major refineries had halted operations. The question isn't whether this creates a crisis. The question is whether your supply chain survives the next 90 days. Welcome to Currency Talks. If you've spent decades watching markets, building businesses, understanding that real intelligence comes from pattern recognition, not headlines, then you already know why you're here. This isn't entertainment. This is economic intelligence that mainstream financial media won't touch. If that resonates with you, if you value analysis over noise, subscribe now, because what we're about to walk through doesn't repeat itself. And before we continue, drop a comment below. What city, what country are you watching from? Because this silver crisis, it's hitting every region differently. Let's see where our community stands as this unfolds. On January 14th, 2025, Mexico's Economy Ministry published a single administrative document. 17 pages, technical language, buried in regulatory updates most analysts never read. The document established mandatory export licensing for refined silver products leaving Mexican territory. Not a ban, not a quota, a licensing system. Within 72 hours, global silver markets began exhibiting behavior patterns not seen since the 1980 Hunt Brothers crisis. But this time, the disruption wasn't coming from speculative traders. It was coming from a sovereign government controlling nearly 1/4 of the world's silver production. Mexico produces approximately 190 million ounces of silver annually. That represents roughly 23% of total global mine output. No other nation comes close to this production volume. Peru produces about 110 million ounces. China contributes approximately 100 million ounces. But Mexico stands alone at the top. For decades, the silver flowed freely into global markets. Refineries in Mexico processed raw ore into standardized bars. Those bars moved to London vaults, New York depositories, Shanghai exchanges. The system functioned on the assumption of uninterrupted supply. That assumption died on January 14th. The licensing requirements themselves appear bureaucratic on the surface. Exporters must now apply for permits. They must disclose destination countries. They must provide end-use documentation. Processing times range from 14 to 45 days. But here's what the technical language actually means. Every shipment now faces governmental approval. Every transaction creates a paper trail. Every destination gets scrutinized. And approvals can be delayed, modified, or denied. Within the first week, export volumes dropped 45%. Not because Mexico banned silver exports, but because the licensing bottleneck created processing delays that effectively halted the normal flow of metal. Refineries that previously shipped 20 trucks per week now shipped 8. The immediate market response revealed something crucial about modern commodity markets. The paper price, the futures contracts traded on COMEX in New York, barely moved. On January 14th, COMEX silver traded at $31.20 per ounce. By January 21st, it had risen to $32.85, a modest 5% increase. But physical silver, the actual metal you can hold in your hand, told a completely different story. Dealers in Dubai began quoting $127 per ounce for immediate delivery. Premiums in Shanghai reached $48 over the COMEX spot price. European refineries implemented allocation systems, limiting customers to 30% of their normal purchase volumes. This price divergence signals something more significant than temporary supply disruption. It signals the breakdown of the fundamental pricing mechanism that has governed silver markets for 50 years. Traditionally, when physical prices rise above paper prices, arbitrageurs step in. They buy COMEX futures, take physical delivery, then sell that metal in the higher-priced physical market. This arbitrage activity equalizes prices globally, but that mechanism requires one critical element: available physical metal for delivery. And that's where Mexico's licensing system creates its real impact. COMEX maintains 2 categories of silver inventory. Registered inventory represents metal available for immediate delivery against futures contracts. Eligible inventory represents metal stored in COMEX vaults, but not available for delivery. On January 13th, COMEX registered silver inventory stood at 48 million ounces. By January 25th, it had dropped to 31 million ounces. Meanwhile, open interest, the total number of outstanding futures contracts, remained above 180,000 contracts. Each contract represents 5,000 ounces. That's 900 million ounces of paper claims, against 31 million ounces of deliverable metal. This creates what market analysts call a squeeze scenario. But this isn't a temporary squeeze driven by speculative buying. This is a structural supply disruption driven by sovereign policy. Mexico hasn't announced any intention to reverse the licensing requirements. Government officials have described the system as necessary for strategic resource management and domestic industrial development. Translation: this isn't temporary. The comparison to previous resource nationalism cases proves instructive. When China restricted rare earth exports in 2010, global prices increased 700% within 18 months. Western manufacturers scrambled to develop alternative supply chains. Some succeeded, many failed. Industries dependent on Chinese rare earths restructured entirely. When Chile began restricting lithium exports in 2023, battery manufacturers faced similar disruptions. But silver presents a more complex challenge. Unlike rare earths or lithium, silver serves critical functions across multiple industries simultaneously: electronics manufacturing, solar panel production, medical devices, photography, investment demand. And unlike those materials, silver has a massive paper market overlay: futures, options, ETFs, that has historically dominated price discovery. Mexico's licensing system puts those two realities into direct conflict: the physical metal needed for industrial production versus the paper contracts traded for speculation and hedging. One system requires actual delivery. The other operates on cash settlement and rolling positions forward. And for the first time in decades, those two systems are pricing silver as if they're trading different commodities entirely. The futures market operates on a premise most participants never question: that paper contracts can always be converted into physical metal, that the exchange maintains sufficient inventory to honor delivery requests, that price discovery happens through transparent functional markets. Mexico's licensing decision didn't break these assumptions overnight. It simply revealed they were already broken. To understand what's happening at COMEX, one must first understand what COMEX actually is. The commodity exchange isn't a warehouse full of silver. It's a ledger system tracking ownership claims, a digital scoreboard showing who owns what. In theory, the exchange maintains approved vaults scattered across the United States. These vaults hold physical metal. But that metal exists in two distinct categories that most traders never differentiate. Registered inventory means metal pledged for delivery against futures contracts. Eligible inventory means metal stored in COMEX vaults, but unavailable for contract settlement. Think of it like hotel rooms. Eligible inventory represents all rooms in the building. Registered inventory represents rooms actually available for booking. The hotel can advertise total room count all day long, but if only 12 rooms are available for guests, while 300 people hold confirmed reservations, the system collapses. On January 1st, 2025, COMEX registered silver stood at 52 million ounces. By February 3rd, it had fallen to 28 million ounces. That's a 46% decline in available delivery metal within 5 weeks. But here's where the mathematics become impossible to ignore. Open interest, the total outstanding futures contracts, currently exceeds 185,000 contracts. Each contract equals 5,000 ounces. That represents 925 million ounces of paper claims, against 28 million ounces of deliverable physical metal, a ratio of 33-1. 33 paper claims exist for every single ounce of actual silver available for delivery. This isn't new. COMEX has operated with high paper-to-physical ratios for years. The system functions because most contract holders never take delivery. They close positions before contract expiration. They roll positions forward into future months. They settle in cash rather than demanding metal. The futures market depends on this behavior continuing forever. Mexico's licensing system attacks that assumption directly. When Mexican silver stops flowing into COMEX vaults, the registered inventory doesn't replenish. When industrial users can't source metal through normal channels, they turn to futures markets for actual delivery. When sovereign wealth funds observe supply disruptions, they demand physical settlement rather than cash. The percentage of contracts standing for delivery, historically around 2%, begins climbing. In January 2025, standing for delivery hit 6.8%. That might sound modest, but at 185,000 open contracts, a 6.8% delivery rate means 12,580 contracts demanding physical settlement. That's 62.9 million ounces. The exchange only has 28 million ounces registered. The math doesn't work. COMEX has 3 options when facing delivery demands that exceed available inventory. Option 1, find additional metal and register it quickly. But Mexico's licensing system makes that nearly impossible. The primary source of new supply can't flow freely anymore, and silver already in eligible storage belongs to entities unwilling to pledge it for delivery at current prices. Option 2, raise margin requirements to discourage delivery demand. COMEX has already implemented this strategy twice since January 14th. Initial margin for silver futures increased from $8,500 per contract to $14,000 per contract. Higher margins force smaller traders out of positions. They reduce speculative interest. They discourage delivery requests from participants lacking deep capital reserves. But margin hikes don't solve the fundamental problem. They simply postpone it. Option 3, force cash settlement. This represents the nuclear option. COMEX rules technically allow the exchange to settle contracts in cash rather than physical metal under extraordinary circumstances. It has never invoked this clause for precious metals, but the possibility now hangs over the market like a sword. If cash settlement becomes reality, the entire premise of futures markets collapses. A gold or silver futures contract exists to provide price discovery and delivery mechanism. If the delivery mechanism breaks, the contract becomes worthless as a hedging tool. Industrial users can't hedge production costs with contracts that won't deliver metal. Mining companies can't forward sell output through contracts that settle in cash. The market loses its primary economic function. This exact scenario played out once before. In 1980, the Hunt brothers accumulated massive silver positions through futures contracts. They took delivery of physical metal. They squeezed available supply. COMEX changed the rules mid-game, implementing liquidation-only trading that prevented new buying. The Hunts lost billions. But the exchange survived because the squeeze came from speculators. This time, the pressure comes from sovereign policy. Mexico isn't trying to corner the market. Mexico is simply controlling its own resources. That makes the situation far more dangerous, because there's no rule change that fixes a structural supply deficit. There's no regulatory intervention that forces Mexico to abandon its licensing system. And there's no precedent for how futures markets function when the underlying commodity becomes subject to export controls from the dominant producing nation. COMEX is discovering the answer in real time, and the answer appears to be they don't function at all. For 5 decades, silver traded as a truly global commodity. A single price reflected global supply and demand. When prices diverged between markets, arbitrageurs eliminated the gap within hours. Buy low in one location, sell high in another, transport the metal, pocket the difference. This process kept Shanghai aligned with London, Dubai synchronized with New York, Mumbai tracking COMEX. That system died sometime during the 3rd week of January 2025, and most market participants still haven't noticed. Arbitrage works because of one simple assumption. Metal can move freely between markets. When physical silver costs $32 per ounce in New York but $38 in Shanghai, traders execute a simple sequence. Purchase COMEX futures. Take physical delivery, ship metal to Shanghai, sell at the higher price. The $6 spread covers shipping costs, insurance, customs, and profit. Repeat this process enough times with enough volume, and the price gap disappears. Shanghai prices fall as supply increases. COMEX prices rise as inventory depletes. The two markets converge toward equilibrium, textbook arbitrage, except Mexico's licensing system broke step 2 of that sequence. Take physical delivery, because the metal needed for arbitrage isn't flowing into COMEX vaults anymore. And without fresh inventory registering for delivery, arbitrageurs can't access the physical metal required to execute their trades. The price divergence that should correct within days now persists for weeks. On February 5th, 2025, COMEX silver futures closed at $33.40 per ounce. That same day, Shanghai Gold Exchange silver contracts settled at $81.15 per ounce, a $47.75 spread. Under normal market conditions, that spread would represent pure profit opportunity. Traders would flood the market with arbitrage orders. They would drain COMEX inventory within 72 hours. They would normalize pricing across exchanges. Instead, the spread widened. Dubai physical dealers began quoting even more extreme premiums. 1 kilogram silver bars, the standard wholesale format, traded at $4,100 per kilogram. That translates to $127.50 per ounce, nearly 4 times the COMEX paper price. The dealers aren't price gouging. They're reflecting actual supply scarcity in physical markets. When a jewelry manufacturer in Dubai needs silver for production, they can't wait 6 weeks for a Mexican export license to process. They can't rely on COMEX delivery that might never materialize. They need metal immediately, so they pay whatever the market demands. And the market demands $127 per ounce. This creates 2 completely separate silver markets operating simultaneously. The paper market, futures, options, ETFs, continues trading based on historical pricing models and speculative positioning. The physical market, bars, coins, industrial feedstock, trades based on actual availability and delivery timelines. These 2 markets now price silver as if they're trading different commodities entirely. India provides another data point illustrating this breakdown. Indian silver imports typically flow through 3 primary channels: direct purchases from Mexican refineries, shipments from Swiss processors, transfers from London vaults. All 3 channels have experienced severe disruption since mid-January. Mexican refineries prioritize domestic buyers due to licensing delays for export permits. Swiss processors face allocation constraints because their feedstock sources from Mexican mines. London vaults show declining available inventory as holders refuse to sell at COMEX-based pricing. Indian dealers responded by implementing rationing systems. Large jewelry manufacturers receive 40% of their typical monthly orders. Small retailers get 20% allocations. Investment buyers face complete unavailability for bars larger than 100 grams, and prices reflect this scarcity. Mumbai spot silver reached $400 per kilogram on February 4th. That converts to approximately $116 per ounce. The Indian government attempted intervention through import duty adjustments. They reduced import tariffs from 15% to 6%, trying to incentivize supply. It didn't work, because the problem isn't tariff structure. The problem is physical metal doesn't exist in sufficient quantity to import. European markets demonstrate the same pattern through different mechanics. Switzerland hosts major refining operations that process raw silver into investment-grade bars. These refineries historically sourced material from multiple origins: Mexican concentrates, Peruvian doré, recycled industrial scrap. But Mexican concentrates represented nearly 35% of European refinery feedstock. When export licenses restricted that flow, refineries couldn't simply substitute other sources at equivalent volumes. South American mines were already contracted to Asian buyers. Recycling operations can't scale quickly enough to offset primary supply shortfalls. The refineries implemented customer allocation protocols. Long-term industrial clients receive priority. Banks and investment firms get secondary allocation. Spot buyers face rejection or extreme premiums. One Swiss refinery began quoting $92 per ounce for immediate delivery. At current exchange rates, that equals $98 USD. The COMEX price at that moment showed $33.20, a nearly 3x premium for actual physical delivery in Europe. This isn't supposed to happen in modern commodity markets. Price discovery mechanisms exist specifically to prevent such distortions. When physical commands a premium, producers increase output. Recyclers activate dormant capacity. Inventory holders release stock. Supply expands. Prices normalize. Equilibrium returns. But Mexico's licensing system prevents the normal supply response. Producers can't simply increase output when export approvals take 6 weeks. Recyclers can't access Mexican scrap metal under the same licensing constraints. Inventory holders in Mexico face domestic pressure to supply local industrial users first. The feedback loop that typically corrects price distortions doesn't function. And without that correction mechanism, the two-tier market becomes permanent. Sophisticated institutions recognize this shift faster than retail participants. Central banks in Asia began requesting physical delivery on existing paper positions. Sovereign wealth funds shifted from futures exposure to direct vault storage agreements. Family offices that previously held silver ETFs started demanding allocated metal in private vaults. These entities understand something crucial. When arbitrage fails, when price discovery breaks down, when paper and physical markets divorce completely, the paper price becomes irrelevant. Only physical possession matters, and physical metal at any price is cheaper than physical metal that doesn't exist at all. The solar panel manufacturing sector was first to recognize the crisis, not because solar executives possess superior market intelligence, but because their production lines started shutting down. Silver paste represents a critical component in photovoltaic cell production. Each solar panel contains approximately 20 grams of silver. That sounds minimal until scaled to industrial volumes. A mid-sized solar facility produces 500,000 panels monthly. That requires 10,000 kilograms of silver paste per month, roughly 320,000 ounces annually. These facilities operate on just-in-time inventory systems. They maintain 30 to 45 days of silver paste stock. They reorder based on predictable delivery schedules from chemical suppliers. Those schedules assumed uninterrupted Mexican silver supply. By late January, 3 major solar manufacturers in Germany reported paste shortages. Their chemical suppliers couldn't source silver at contracted prices. Spot market purchases would push paste costs up 240%. At those input costs, solar panel production becomes economically unviable. The facilities faced a choice: shut down production lines, or accept paste deliveries at prices that guarantee losses on every panel manufactured. 2 chose temporary shutdown. 1 attempted to negotiate long-term contracts at the inflated prices. But here's what that single decision reveals about the broader market. When industrial users start locking in supply at any price, they remove additional metal from available circulation. They prioritize supply security over cost optimization. They signal to the market that physical availability matters more than paper price discovery. Electronics manufacturing demonstrates the same pattern at larger scale. Silver serves essential functions in semiconductors, connectors, switches, and circuit boards. The consumer electronics sector consumes approximately 240 million ounces annually. That demand doesn't disappear because Mexican export licenses slow supply. Smartphone production schedules can't simply pause for 6 months waiting for silver markets to stabilize. Contract manufacturers in Taiwan, South Korea, and China began stockpiling silver in early February. not stockpiling in the traditional sense of building strategic reserves over months, stockpiling in the panic sense of purchasing any available silver regardless of premium. One Taiwanese electronics firm reportedly purchased 200,000 ounces at $89 per ounce. Their typical procurement cost averages $34 per ounce. They paid a 162% premium, and they considered it prudent risk management, because the alternative, production line shutdown, costs far more than expensive silver. Medical device manufacturing faces even more critical constraints. Silver's antimicrobial properties make it irreplaceable in certain surgical instruments, wound dressings, and catheter coatings. These aren't consumer products, where manufacturers can substitute alternative materials. These are life-saving medical devices, subject to years of regulatory approval. A catheter manufacturer can't simply switch from silver coating to copper coating. That would require new clinical trials, new FDA approvals, new safety certifications, a process taking 3 to 5 years. So when silver supplies tighten, medical device firms pay whatever the market demands. They have no alternative. This inelastic demand creates a floor under physical silver prices, regardless of paper market behavior. Even if COMEX futures somehow crash to $20 per ounce tomorrow, medical and electronics manufacturers would continue paying $80+ for physical delivery, because they need the actual metal, not paper claims. Meanwhile, institutional investors have begun repositioning in ways that will amplify the supply deficit. Central banks historically viewed silver as a secondary monetary metal. Gold received the strategic allocation. Silver remained a minor portfolio component. That calculus is shifting. When a commodity's primary producer implements export controls, that commodity becomes a strategic resource. Strategic resources require sovereign ownership, not futures market exposure. At least 3 Asian central banks have initiated programs to acquire physical silver for direct vault storage, not through ETFs, not through COMEX positions, through bilateral agreements with refineries for allocated segregated metal. These purchases don't show up in exchange inventory data. They don't register in futures market open interest. They simply remove metal from global circulation permanently. Sovereign wealth funds are executing similar strategies. Norway's government pension fund, Singapore's GIC, Abu Dhabi Investment Authority. These entities manage trillions in assets. They operate on decade-long time horizons. They don't trade based on quarterly performance. When they identify structural supply constraints in strategic commodities, they accumulate physical positions quietly. A 0.5% allocation to physical silver from just these 3 funds would represent approximately 180 million ounces. That's more than the entire COMEX registered inventory, and they wouldn't be buying to trade. They'd be buying to hold for 10 to 20 years. Mining companies face their own reckoning. Many silver miners sold forward production to hedge price risk. They locked in prices of $24 to $28 per ounce for deliveries extending through 2026 and 2027. Those contracts made sense when silver traded below $30. They represent catastrophic losses when physical silver trades above $80. Some mining companies are attempting to unwind these forward sales. They are buying back contracts at current market prices to avoid delivering physical silver at contracted prices far below market. But unwinding forward sales requires purchasing silver in the same physical market, experiencing severe shortages. The very act of buying back hedges removes additional supply from circulation. This creates a reflexive loop. Supply tightens, prices rise. Hedges become unprofitable. Miners buy back hedges. Supply tightens further. The derivative exposure layered throughout the financial system magnifies these dynamics. Major banks hold significant short positions in silver futures and options. These positions were established as hedges against client loans to mining companies, or as market-making inventory for structured products, or as proprietary trading positions betting on continued low prices. When physical and paper markets diverge dramatically, these derivative positions become impossible to hedge properly. A bank holding a 10 million ounce short position on COMEX faces minimal risk if silver rises from 32 to 38. They lose 60 million, painful but manageable. But if physical silver trades at 127 while COMEX shows $33, what's the true exposure? Do they owe clients the paper price or the physical price? If contracts settle in cash, COMEX prices, but clients demand physical delivery, who bears the $94 per ounce gap? These aren't theoretical questions. They're becoming real-world contract disputes happening right now in arbitration proceedings worldwide. The strategic conclusion for any business dependent on silver is unavoidable. Mexico's licensing system represents permanent structural change, not temporary disruption. Paper markets can no longer provide reliable price discovery or delivery assurance. Physical supply security now requires direct relationships with producers or processors, and waiting for normal market conditions. To return means waiting for something that is not coming back. Industrial users must secure long-term supply agreements now, regardless of price. Investors holding paper silver claims should consider conversion to allocated physical metal. Companies with silver derivative exposure need immediate stress testing of worst-case scenarios because the market hasn't fully priced in the implications yet. COMEX still trades as if this is temporary. But sovereign export controls don't reverse. They expand. And when 45% of global supply operates under licensing restrictions, the only rational response is assuming the other 55% will eventually face similar constraints. Because every silver-producing nation just watched Mexico demonstrate how to weaponize strategic resources without firing a single shot.